So the stock market has recovered some of what was lost in all this tariff nonsense. At the lows, the S&P 500 was down almost 20%, but as of now, it's clawed back about half that. So there's so many traders out there who have this plan in their head that they're just going to wait for the stock market to crash, and then they're going to pile in with all of their short volatility trades. Now, I've talked a lot about why buying long put options, for example, doesn't work on things like the VIX, VXX, UVXY. Due to the big Vega headwind, long options are just way too expensive in a market crash, and they won't be very profitable. But a lot of traders think, well, okay, I'm going to be the smart one, and I'm actually going to short volatility by buying the inverse volatility ETPs like SVIX. Since there's no Vega component when you're buying an ETF, then SVIX should recover very quickly when the stock market does, right? Wrong. Let me show you why that's a terrible way to buy the dip when the market crashes. Now, first of all, I would encourage all of you to follow me on Twitter because I often give tips and warnings about trade ideas so people know what they may be walking into. But buying the dip with volatility ETFs like the SVIX doesn't work simply because of how it's structured. Remember, it's not supply and demand that drives its price. It functions based on a methodology of rolling VIX futures. It's essentially the relationship between the front 2-month VIX futures and the spot VIX index price. I call this the VX30 to VIX roll yield. This is everything if you want to understand volatility ETFs, and I've got a great video that you can watch after this one that explains it all. But essentially, it comes down to that roll yield. When it's positive, SVIX has a tailwind, and it will likely perform pretty well. This is what we see during stable markets, and this is why short volatility can actually significantly outperform the stock market during calm periods. But when that roll yield is negative, that's a headwind for SVIX, and it likely won't perform very well. So remember, with stocks, there is only one variable. It's supply and demand, and if people start buying stocks, then of course it's going to go up. With short volatility and buying the SVIX, there's two variables you have to be aware of. First, yes, there is a positive correlation with the stock market, and they typically do both go up at the same time. But there's that secondary factor of VIX futures roll yield that is just as big, if not bigger, than the directional price. So the S&P 500 bottomed on April 7th. Let's just say you timed it perfectly, and that's when you're going to buy the dip. Well, this is the VIX futures term structure on that same day, April 7th, 2025. The front 2-month VIX futures were 15% in backwardation, and with the VIX index trading at 47, there was a huge negative VX30 to VIX roll yield on that day. That's a massive headwind for the SVIX. Like I said, your crystal ball told you to buy on April 7th, and the S&P 500 did start going up again. But this is what the SVIX chart looks like. Sure, it also started going up a little bit again on April 7th as well. That's that positive correlation that most people know about. But because there's still such massive negative roll yield in the VIX futures market, that recovery in SVIX is going to be awfully slow on a relative basis. And remember, I'm just comparing the SVIX to the SPY, but that's not even a fair comparison because the SVIX is highly leveraged compared to the stock market. I'll just quickly define it here. You don't have to know how to calculate this, but beta is a measure of how one security moves in relation to another security, and it shows both the direction and the magnitude. So in this case, SVIX versus the S&P 500. It'll be a positive number because they move in the same direction. And then the higher the value, the more SVIX moves in relation to the S&P 500. So a beta of 1, for example, would mean the SVIX moves similar in both direction and magnitude to the S&P 500. But these are the actual beta factors, and we can see it's definitely not 1-to-1. That blue line is showing SVIX to the SPY, which is just 1 times the stock market. And SVIX is basically 3 times leveraged. SVIX on average moves 3 times faster than the SPY. If we want to match up beta factors, we have to go all the way to the 3 times S&P 500 with the UPRO. SVIX and UPRO move about the same speed long term. So for traders who bought the dip with SVIX, they probably thought it was going to do really well because stocks also started recovering, and by all accounts, it should recover 3 times faster. It should be a great trade. But unfortunately, the massive negative VX30 to VIX roll yield is going to make that recovery in the land of short volatility much slower. Buying the dip with short volatility is unfortunately just a rookie mistake. So now you can either go to the next level of education and learn how those volatility ETFs actually function based on the VIX futures, or you can check out this video where I explain how I personally use the volatility products to make over 30% a year with tactical rotation. See you in the next video.